If you are holding CSE Global in your SRS portfolio, hoping for that steady, reliable income stream we all crave, the latest financial results probably felt like a nasty splash of cold water. On the surface, if you just glanced at the headlines on the Business Times or a quick brokerage report, things look decent. Revenue is up, net profit climbed a healthy 8.5%. Everything seems fine, right? But then you looked at your dividend payout. You saw the interim dividend slashed from 1.25 cents down to 1.14 cents. You saw the stock wobble. And you probably asked yourself, wait a minute, if the company is making more profit, why am I getting paid less? That is the scary headline. Profit is up, but your payout is down. But if you strip away the one-offs and really dig into the accounts, the real decline is actually much more complex than just a dividend cut. The headline number of an 8.5% profit increase is masking a very different reality. If you dig past the first page, you see operating cash flow turning significantly negative and a forward-looking order book that has dropped by double digits. For us as Singaporean investors seeking stability, this divergence between accounting profit and actual cash flow is one of the most dangerous setups to navigate. Is this just a temporary stumble as they pivot to the US market? Or is the entire growth story stalling out? That is the puzzle we are going to solve today. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the fluff, and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work to make sure you have the best data possible. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls before the rest of the market catches on. Today, we are going to do exactly that with a deep dive, page by page, through CSE Global's 1H 2025 results to see if this is a buy, a hold, or a sell. Let's start our methodical breakdown with the headlines versus the reality. We need to look at the first half 2025 financial snapshot. CSE Global reported its results for the period ended 30th June 2025. And at first glance, it shows a company that is growing its top line. Revenue came in at 440.8 million Singapore dollars, which is a 2.8% increase year on year. Gross profit was also up 3.8% to 122.9 million. And there's that net profit figure we talked about, $16.3 million, up 8.5% from the previous year. Now, let me explain why you need to be very careful with that net profit number. In finance, we talk about the quality of earnings. High quality earnings come from selling more products or services. Low quality earnings come from accounting adjustments or selling off assets. If you look closely at the EBITDA breakdown for CSE Global, the profit in their electrification segment jumped 14.4%. Sounds great, right? But why did it jump? It was largely due to a one-off net gain on the disposal of an asset held for sale, which amounted to $5.5 million. Think about that for a second. The total net profit is around 16 million. A huge chunk of the growth came from selling a physical asset, not from operations. Without selling the asset, the profit growth story would look significantly weaker, perhaps even flat or negative. This is what I call low quality earnings growth. It's like saying you earned more money this month because you sold your car. Yes, you have more cash in hand, but you can't sell your car every month. Let's move to the next page and look at the engine room, the segment performance. This is crucial because CSE Global is trying to tell a specific story to the market. The narrative has been a pivot toward electrification and communications, mostly in the US market and away from their traditional legacy automation business, which is tied to oil and gas. The results show us that this transition is incredibly messy. First, let's look at electrification. Revenue was actually down 0.9%. Management says this dipped due to a weaker US dollar, which is fair. Currency headwinds happen. But as we just mentioned, EBITDA surged due to that one-off asset sale. So the core business of electrification was actually a bit soft on the top line. Next, we have communications. This segment is flying in terms of revenue, up 12.7%. This was driven by acquisitions which added about $17 million to the top line. But here's the red flag. Despite revenue growing by double digits, EBITDA was basically flat, up only 0.3%. What does that tell us? It tells us that the margins collapsed. It suggests they are buying revenue via acquisitions, but these new revenue streams are much lower margin than their existing business. You never want to see a company growing sales by 13% but profit by 0%. It means they are working harder for the same amount of money. And then we have the third engine, automation. This is the legacy business, and frankly, it is bleeding. Revenue was flat, but EBITDA crashed by 37.3%. Why? There was a massive $5.1 million write-off of plant, equipment, and technical know-how. This is the real anchor dragging the ship. While they try to sail toward electrification, the automation segment is pulling them back. So from my perspective, the electrification thesis is currently being masked by currency fluctuation and asset sales, while the real story is the massive drag from the legacy business. CSE is effectively running on one engine while the other is broken. Now, let's move to the most critical section for anyone relying on dividends. We need to talk about the red flags, cash flow, and the order book. First, let's define operating cash flow. This is the actual cash generated by the business operations. It is not accounting profit. It is real money entering the bank account. In the first half of 2024, CSE generated positive $15.8 million in cash. That is healthy. But in the first half of 2025, they burned through negative $27.4 million. That is a massive swing. Why did this happen? The report cites higher working capital tied up in projects. So here, let me explain what that means. When a company reports net profit but bleeds cash, it usually means one of two things. Either they are recognizing revenue on paper but haven't collected the money from clients yet, which is an accounts receivable issue. Or they are spending heavily upfront to fulfill contracts before they get paid. This is a dangerous spot for a dividend payer. Cash flow is the lifeblood of dividends. You cannot pay a dividend with net profit or accounting entries. You pay it with hard cash. The fact that CSE cut the interim dividend to 1.14 cents is a direct admission by management that they need to preserve liquidity. They don't have the excess cash to be generous right now. And when we look at the balance sheet, net gearing is creeping up to 0.36 times. It's not at a crisis level yet, but they are definitely getting tighter on cash. The second red flag is the shrinking pipeline. We look at the order book. This is essentially the backlog of work they have signed but haven't done yet. It is the crystal ball for 2026 revenue. The order book stands at $573.8 million. That sounds like a big number, but it is down 17.1% from last year. If the bucket isn't being refilled faster than it's being emptied, growth will eventually stop. A dropping order book combined with negative cash flow is a classic warning sign that the business momentum is slowing down. So, bringing this all together into Iggy's assessment, what is working and what isn't? What is working is the strategic shift in geography. They are successfully becoming a US-centric infrastructure player. America's revenue is now $294.7 million compared to APAC's $134.8 million. That exposure to the US economy is generally a good thing for diversification away from Singapore. However, what is not working is significant. The transition costs are too high. The legacy business is hurting the bottom line with write-offs. The margins in the new communication segment are too thin. And most importantly, the cash conversion cycle has deteriorated. Let's talk valuation and the final verdict. The stock might look attractive to some of you on a price to earnings or PE basis. You might see that 8.5% profit growth and think it's cheap. But remember, the E in PE is inflated by that asset sale. And the shrinking order book suggests that earnings might be under pressure next year. So here is my recommendation. For existing unit holders, especially those of you holding this in your SRS for income, I would be very cautious. The dividend cut and negative cash flow are sell signals. If you rely on this for passive income, the risk of further cuts is non-zero. I wouldn't necessarily panic sell everything today, but I would certainly not be reinvesting dividends back into the stock right now. You need to watch that cash flow number like a hawk in the next quarter. For new buyers who are looking at the dip and thinking about entering, my advice is to wait. The risk reward isn't there yet. I'd wait for a price that reflects the reality of a shrinking order book, or better yet, wait for a quarter where they prove they can generate positive cash flow again. Do not catch a falling knife just because the PE looks low. Overall, I am moving CSE Global to a watch status. The discrepancy between their accounting profits, which are boosted by one-offs, and their operational reality, which shows negative cash flow and shrinking orders, is simply too wide for my comfort. I want to see 1 quarter of positive operating cash flow and a stabilizing order book before I consider this investable again. That wraps up our deep dive into CSE Global. I know these numbers can be dense, but understanding the difference between profit and cash flow is what separates the successful investors from those who get caught in value traps. If you found this analysis valuable and want to get these updates straight to your inbox, consider becoming a free or paid subscriber to our Substack newsletter. The link is right there in the description. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support allows us to keep cutting through the noise. Thanks for watching. Stay rational out there, and I'll see you in the next analysis.